If you received a big chunk of money right now, how would you invest it? Would you put it to work in the market immediately, or would you invest it gradually by spacing it out over time? And you might say, Duke, if I received a big chunk of money right now, I wouldn't invest it at all. I would spend it. But listen, I'm not going to give you that option because that's not what this video is about. This video is about how to invest a one-time chunk of money that you might receive, a windfall, if you will. Maybe you get an inheritance, or sell a house or a car, or get a big bonus at work, sell a business, or any number of exciting financial events. And even if you think this will never happen to you, I think it will. In my experience, life happens and chunks of money happen, although not as often as I'd like. Anyway, you will likely face this question at some point, so the question remains: how to invest a big chunk of money? And there are really two ways to invest it, assuming that you're investing it in an asset that you expect to increase in value over time, like the stock market. You could invest the money all at once in one lump sum. This is called lump sum investing. You just take the whole pile and dump it into the market and wish it luck, and that's that. You close your eyes and buy. Whatever the price of the investment is at that time is exactly the price you pay. The other option is you could spread the money out over time by investing it in smaller chunks periodically. This is called dollar cost averaging. For example, if you had $10,000 to invest, you might invest $1,000 each month for 10 months until it's all been invested. And your cost to buy the investment gets averaged out over each of those months. You don't know exactly how much you will end up paying for the investment. It could be higher or lower as you buy into it. Your cost in the end is the average of those separate purchases. All right, so that's the dilemma. Given a fixed chunk of money, what's the best way to invest it? Lump sum investing or dollar cost average investing? If you think lump sum is best, you're correct. But if you think dollar cost average investing is best, well, you might also be correct. Statistically speaking, lump sum investing is the preferred way to go. The reason is quite simple. The market goes up. That's why you're investing in the first place. And if the market is going up, it's best to get in now at whatever price it currently is, because it's likely to be higher if you wait to invest. Any money not invested, therefore, is going to lower your return. This makes intuitive sense, but the market is volatile and can definitely go down on its way to going up. So there's a risk that you put the money to work today only to see the market decline in value tomorrow, and in that situation, you lost out because you overpaid for the investment. In the short term, your investment actually lost value, quite the opposite of what you were hoping for. Ouch. But even given this risk, lump sum investing comes out ahead most of the time. Vanguard looked into this in a research paper published earlier this year, which I will link to in the video description. They write, imagine receiving a windfall due to an inheritance, a bonus payment, or the sale of a small business. How would you invest the cash? Would you immediately invest all of it as a lump sum, or would you make a series of investments over time, a strategy known as cost averaging, to avoid the risk of investing the entire amount right before a market downturn? In this paper, we compare the performance of cost averaging with lump sum investment across various markets, historical periods, and simulated return scenarios to determine which strategy most often works best. So they looked at investing in 100% equities using returns from 1976 to 2022, and what they found was that lump sum investing outperformed dollar cost averaging 68% of the time. That is statistically significant compared to, say, 50%, which would indicate that it really doesn't make a difference which method you use. 68% tells us that lump sum investing is the logical choice, which outperforms most of the time. So, statistically speaking, you're better off throwing it all into the market as soon as possible, all at once, even if you're scared. Scared. See, that's the reason there is this question at all. The fear of losing money. If the market was guaranteed to only go up in a perfectly straight line, this would be so easy. We would all put as much money into the market as soon as possible. We might even sell possessions just to get more money in there right away and watch our wealth grow. But we all know the market doesn't just go up. It's a bumpy ride, and sometimes it can go down, way down, before it goes back up. And if the market goes down, we would actually be better off dollar cost averaging, getting lower prices as the market goes down. So it's no wonder that when we have a chunk of money, we may be hesitant to invest it all only to watch it decline in value. It's just a psychologically hard thing to do. What if we could get a better price tomorrow? What if we're on the verge of financial Armageddon? How can we just close our eyes and buy with this uncertainty? This is the reason that some of us would prefer to dollar cost average our money into the market. It helps us eliminate the regret of buying at a worse price than we could have if we waited. It simply feels better. And in a way, dollar cost averaging is how most of us contribute to our investments most of the time. If you have a 401k or similar account at work, you are likely making regular contributions each pay cycle. Therefore, you are naturally dollar cost averaging. Although one could argue that contributing from a paycheck isn't truly dollar cost averaging. It's kind of like lump sum investing with the small chunk of money that's available at that time. But it also makes it easier for us to stomach the market's ups and downs because we know we're contributing whether the market is up or down. We're buying more shares when it's down and less shares when it's up, and we don't have to wonder if now is the right time to buy or not. And for many of us, that feels better than if we had to buy in all at once. And there's a lot to be said for that because if the choice is between dollar cost averaging and not investing at all, it's way better to dollar cost average and get that money to work, even if it takes longer. The same Vanguard study that I mentioned earlier also compared each strategy to simply holding cash and found that dollar cost averaging outperformed cash 69% of the time. Nice. And lump sum investing was just slightly better, outperforming cash 70% of the time. So if dollar cost averaging helps you to actually get that money to work in the market versus keeping it on the sidelines, then by all means go for it. Compared to holding cash, lump sum investing or dollar cost averaging are both going to lead to better outcomes most of the time. And as a long-term investor, you should always remember that classic phrase that I will trot out here at the end of this video: time in the market beats timing the market. So while lump sum investing is better 68% of the time, either method is fantastic as long as in the end it gets your money working for you instead of sitting in cash. Because cash is not going to build wealth for you. Investing for the long term will. All right, that's what I have for you in this video. Be sure to give this video a like and subscribe to my channel for more videos on saving, investing, and early retirement. Thanks for watching.